Gold and silver just hit a key bottom. The next move is beginning. Somewhere in a quiet room, a decision has already been made. Not by you, not by the public, but by the institutions that move first and explain later. A bottom is formed quietly, almost invisibly. And history shows this is precisely the moment when the smart money stops watching and starts positioning. The question is no longer if the next move happens. It's whether you will be standing on the right side of it when it does, because what comes next will not wait for permission. Stay with this story until the end, because the final part changes everything. Welcome back to Precious Metals Intelligence, the channel dedicated to helping serious, forward-thinking individuals understand the strategic currents shaping gold, silver, and the broader economic order before the headlines catch up. Before this analysis begins, it would mean a great deal to know one simple thing. Where in the world are you watching from today? Take a moment, type your city or country in the comments below. This community has grown into a genuinely global gathering of thoughtful, discerning viewers. And it's always worth knowing just how far this conversation reaches. For years, the world of gold and silver has followed the same quiet rhythm. Prices rise, prices fall, investors get excited, then they get scared. Most people watch the news and react only after the big move has already happened. But the ones who understand markets deeply know something different. They know that the most important moments in any market are never announced. They are only recognized later once it is too late to act on them cheaply. This is the story of one of those moments. To understand why this matters, it helps to first understand what a bottom really means in financial markets. A bottom is not simply a low price. It is a turning point. It is the place where selling pressure runs out of strength and buying pressure quietly begins to take control. Most investors imagine that bottoms look dramatic, like a sudden crash followed by a sharp bounce. In reality, most bottoms are boring. They are slow. They are filled with doubt. They often look like nothing special is happening at all. This is exactly why so many people miss them. Think about how fear works in a market. When prices have been falling for months, people stop believing in a recovery. They read negative news. They hear experts say prices will fall even further. They watch other investors sell their positions in frustration. By the time a real bottom forms, almost nobody believes it is happening. That is not a coincidence. That is how bottoms are built. They are built on exhaustion, not excitement. History has shown this pattern again and again in the gold and silver markets. Every major low point in these markets shared a similar emotional structure. First, there was a long period of decline that tested investors' patience. Then came a final wave of selling, often the sharpest and most painful part of the entire decline. This is the point where even long-term believers start to give up. And then, almost quietly, prices stop falling. Not because good news arrived, not because a crisis ended, but simply because there were fewer and fewer people left who wanted to sell. Long before headlines announce a recovery, the market itself begins to whisper it, not through price alone, but through the quiet behavior of the assets that move ahead of the herd. This is where the story deepens. In the language of technical analysis, this phenomenon carries a specific name: divergence. It occurs when two closely related assets, in this case, mining equities and the metals they extract, begin to disagree with one another. When gold and silver post a lower low, yet the companies that produce them refuse to follow, something meaningful is taking place beneath the surface. Miners, by their very nature, are leveraged expressions of metal prices. They tend to fall harder in downturns and rise faster in recoveries. So when they decline less than expected, or refuse to decline at all, it often means that professional capital, the kind that moves early and rarely explains itself, has already begun accumulating. This is not speculation. It is pattern recognition, built on decades of recurring market behavior. History offers several instructive parallels. In prior cyclical corrections, periods where gold and silver spent months grinding lower before stabilizing, mining equities consistently showed early signs of resilience before the metals themselves confirmed a bottom. Analysts who studied these moments closely noted the same recurring structure: a final, unconvincing low in the metal, accompanied by a comparatively higher low in the shares. It is, in essence, the market's way of revealing its hand before the broader public notices. For the business-minded observer, the analogy is straightforward. Consider a company whose stock price falls sharply after disappointing headlines, while insiders quietly increase their ownership stakes during the decline. The headlines may still sound negative, the sentiment may still feel fragile, but the underlying action, the accumulation, tells a very different story than the noise on the surface. This is precisely the dynamic now unfolding in the precious metals sector. Alongside this divergence, a second, equally important layer of evidence deserves attention: investor positioning. Historically, major bottoms in gold and silver are not marked by optimism. They are marked by exhaustion. Capital flows out of gold-backed funds, allocations shrink to multi-year lows, And professional surveys reveal a growing consensus that the metal is overvalued or irrelevant, even as prices sit near cyclical lows. This is not a coincidence. It is, in fact, one of the most reliable contrarian signals available to disciplined market historians. When the percentage of professional fund managers describing gold as overvalued collapses to levels not seen in years, it does not suggest weakness ahead. It suggests the opposite, a market that has been emptied of speculative enthusiasm, leaving only genuine long-term holders in place. Historically, these moments, quiet, unglamorous, and largely ignored by mainstream financial media, have preceded some of the most durable rallies in the sector's history. There's also a broader allocation story worth understanding. Across family offices, institutional portfolios, and everyday investment accounts, exposure to gold remains remarkably low relative to historical norms. The vast majority of large capital pools hold little to no allocation to the metal at all. For a business professional evaluating risk and opportunity, this detail is not trivial. It suggests that the current environment resembles the early stages of a cycle, not its conclusion. None of this guarantees an immediate or uninterrupted advance. Markets rarely move in straight lines, and history shows that recoveries of this nature tend to unfold in stages, a rebound, followed by consolidation, followed by renewed strength, rather than a single decisive surge. Patience, not urgency for its own sake, has historically rewarded those who understood this rhythm. What matters most at this stage is recognizing the pattern for what it is, a structural signal, not a promise. The miners are speaking before the metals confirm. Positioning has thinned to levels historically associated with major lows, and beneath a surface that still feels uncertain to the casual observer, the foundation for the next phase appears to be quietly forming. Once a structural bottom has been identified, the next question a disciplined analyst must ask is not whether a recovery is underway, but how far it is reasonably likely to travel before encountering resistance. This distinction matters enormously, because enthusiasm without measurement is how disciplined investors become reckless speculators. To answer this question responsibly, market historians typically turn to a method known as analog charting, overlaying the current price structure against prior corrections of similar magnitude and duration. The logic is simple. Markets are, at their core, expressions of collective human behavior, fear, hesitation, conviction, and eventually confidence, and these behavioral cycles tend to repeat in structurally similar ways, even if the exact numbers differ from one era to the next. When gold's current correction is measured against its previous major cyclical pullbacks, episodes that followed periods of extended multi-year advances, a recognizable pattern begins to emerge. These prior corrections shared common characteristics: a prolonged decline, a period of consolidation that tested investor patience, and finally, a rebasing process before the next leg higher began. In some historical instances, the recovery that followed was explosive and rapid. In others, it was slower, more deliberate, and required several months to fully unfold. The honest analytical position is not to assume the most dramatic outcome, but to recognize that a range of plausible recoveries exists, bounded by historical precedent rather than wishful projection. This is where resistance zones become critical. In technical analysis, resistance represents a price level where previous selling pressure was strong enough to halt or reverse an advance. These zones are rarely arbitrary. They typically align with prior peaks, prior points of failed rallies, or long-term moving averages that many institutional participants use as decision-making benchmarks. As gold and silver work through their present recovery, several such zones lie directly ahead. The most immediate is defined by the peak of the last minor rebound before the final leg of the correction began. Beyond that lies a secondary zone, marked by a longer-term moving average, a level often treated by larger market participants as a dividing line between a market still in repair and one that has fully stabilized. For silver, historically the more volatile of the two metals, resistance tends to cluster around prior breakdown points, price levels where earlier selling accelerated sharply. Because silver often moves with greater amplitude than gold, both on the way down and on the way up, these resistance zones deserve particular respect. A retracement toward these levels would not, in isolation, confirm that the larger bottom has been fully secured. It would, however, represent a meaningful test, the kind of test that separates a genuine structural recovery from a temporary, unsustained bounce. Equally important to this analysis is price behavior at the smallest visible scale, the weekly candle. To the casual observer, a candlestick chart may appear to be little more than decorative detail. To the trained analyst, however, these formations often reveal the underlying tug-of-war between buyers and sellers more clearly than any headline or news cycle. Specific reversal patterns, formations where a session opens with heavy selling pressure but closes near its high, effectively rejecting the lower prices, have historically appeared with notable consistency near major turning points, When such formations appear not once, but in succession over multiple consecutive weeks, they suggest that selling pressure is not merely pausing, but genuinely exhausting itself. This is precisely the kind of technical evidence now visible in both gold and silver's recent weekly structure. A gradual, session-by-session shift from aggressive selling to tentative, then increasingly confident buying. None of this constitutes certainty. Markets, by their nature, resist guarantees. But when structural analogs, resistance mapping, and short-term price behavior all point in the same direction, a market attempting to repair itself after a prolonged decline, the weight of evidence becomes difficult to dismiss as coincidence. The next section will step back from these near-term technical details to examine something far larger, the historical relationship between gold and broader financial markets, and why that relationship may be signaling the earliest stages of a multi-year strategic shift, one with implications extending well beyond the price of any single asset. To fully understand what may be unfolding in gold and silver, it becomes necessary to step away from short-term price charts entirely and examine something far broader, the historical relationship between gold and the stock market itself. This relationship, often overlooked by casual observers, has quietly preceded some of the most consequential wealth transfers of the past century. When measured not in isolation, but as a ratio against major equity indices, gold reveals a pattern that recurs across multiple economic eras. At each of the market's most significant secular peaks, moments when capital dramatically rotated away from traditional financial assets, this ratio experienced an extraordinary surge beforehand. These were not modest incremental shifts. They represented capital movements of such scale that they fundamentally altered the balance between paper assets and hard assets for a generation. The pattern is instructive precisely because of its consistency. Each major turning point in modern financial history was preceded by a dramatic flow of capital out of equities and into gold, often unfolding over a period of years rather than months. This rotation was never driven by short-term sentiment alone. It was driven by a deeper, more structural loss of confidence in paper-based systems, currency devaluation, inflationary pressure, or growing skepticism toward centralized financial mechanisms. What makes the present moment analytically significant is this. When measured against these historical precedents, the recent movement in the gold-to-equity ratio remains comparatively modest. The scale of rotation observed so far falls meaningfully short of the extreme, capital-altering surges that historically marked the culmination of a gold bull market, rather than its beginning. In other words, the kind of dramatic, headline-driven mania that typically defines the final stage of a secular gold advance has, according to this measure, not yet occurred. This is a critical distinction for the strategic thinker to internalize. Markets do not become genuinely dangerous, in the sense of a mature, overextended cycle nearing exhaustion, until this kind of extreme rotation has already taken place. By that historical standard, the current environment appears to reflect an earlier stage of the process, not a later one. For the business professional accustomed to evaluating cycles, this framework should feel familiar. Industries, technologies, and economic regimes tend to follow recognizable life cycles. An early phase characterized by skepticism and low participation, followed by a middle phase of gradual recognition, and finally a late phase marked by widespread enthusiasm and overextension. Applying the same framework to gold's relationship with broader financial markets suggests the current phase remains closer to the early to middle stages of that cycle, rather than its conclusion. This does not imply an uninterrupted or linear path forward. Strategic economic shifts of this magnitude rarely unfold without setbacks, false signals, and periods of renewed doubt. History suggests that a rotation of this scale, one substantial enough to mark a true generational transfer of capital between paper assets and hard assets, typically requires an extended window of years, not months, to fully mature. Along the way, equities and gold may move in tension with one another for extended periods before any decisive resolution becomes evident to the broader public. What this analysis offers, then, is not a short-term prediction, but a strategic orientation. If the historical pattern holds, the coming years may represent a critical window, a period in which the relationship between traditional financial markets and hard assets begins to shift in a manner not yet fully appreciated by mainstream consensus. The final section of this analysis will bring these threads together, examining the mining sector's own historical breadth patterns and what they suggest about the timing, structure, and ultimate significance of the recovery now taking shape.